Hi everyone, a very warm welcome to the Strikers, the Indiacharts community. And for those who are new to the platform, Indiacharts is where I publish my content. You can simply follow it by downloading the Indiacharts app. Of course, it's a subscription based model. And Strike is the data analytics. I mean, if you really are a self-investor, self-driven person who wants to figure out what to do in the markets, what are the fundamentals of a company, look at all historical data, and at a click of a few buttons want to scan the entire market, Strike is the go-to platform. You will not get any other platform which has all the data analytics one place and at this price. Impossible. Nobody will do it. We have done it. So go out and try the 7-day free trial and kick it off. So what am I going to talk about today? So much has happened since my last podcast, 2 weeks in the market. I've been thinking of doing a Twitter Spaces, but no time for that yet. We'll figure it out. And of course, the markets also have to make you feel like doing something, right? They've been so subdued that you actually feel peeved. Subdued meaning even the volatility is completely disappeared. Initially, it was wildfire buying, selling because of some reason. And now it's like you're not even moving 100 points, forget 50 points in a day. So this kind of suppression, why, makes completely no sense. Sometimes I just blame the one conspiracy theory. It's called weekly options. And I wait for the day at least we take one step forward, which is do away with all these multiple, expiries every day, which is part of the proposal. Going to one expiry will make a lot of difference, because when we actually study even the PCR data and market data, and we find that it used to move much more smoothly before weekly options, and it has become a little jumpy when we look at the open interest data of the option side. The future side is much easier, so I still track the index futures. We stop plotting the other part of the data till it smoothens itself and we feel incentivized to actually do it all over again. So that is where we are on the overall subject. But coming back, what are these markets really doing? I mean, if that is the question in your head, let me try and explain at least the parts that we know, and then I'll give you my conclusive remarks. I've of course been writing about it every day as I do. Sometimes things take time, sometimes they happen immediately. But I do feel a little more confidence because of, one note on sentiment that I wrote out today, but I'll come back to it at the end. And so till then, let's go on and what has happened. So the market did start the month with a bump up. And this bump up came after the budget, right? So budget also, it was slightly subdued, market sold off. Then it was like just flatlining, making a base, not making new lows, but making a base. There was some intermarket divergence. Now, what is an intermarket divergence? Well, the Nifty was not making a new low, maybe Bank Nifty made a new low or something like that. And then from there, it went up, rapidly. In 2-3 days, from one expiry to the next, we were at a new high, 25,100 plus. And then again, we sold off. And then came the yen carry trade, right? That's what drove that sell-off. And by now, everybody knows yen carry trade, kya hota hai, kidhar ja raha hai. And if you know about the yen carry trade, then you know the end result, right? By few days after that, people are saying, yeah, 85% is closed out. I think by now, everything is closed out, because this is essentially a margin call. And it's a bigger call for people who've taken more recent positions, not hedged and so on. For people who've had a position, say I did a yen carry trade 1 year ago or 2 years ago, US market is up, I'm making good money. Why does it really bother me? And many people also hedge. Let's presume that is true. So it's only the unhedged positions, open positions, new positions that end up making losses have to actually wind it up because their stops are getting hit. And also because you have a risk manager, especially at the big fund houses, who will come up with a VAR report. They will show it to you and say, boss, your VAR has gone up. You need to reduce it and bring it back to the company normal. And so therefore, that extent of positioning needs to be reduced. Most of this happens instantly, so it's mostly should be considered as over. Now, will it come back to haunt us? I don't think so, because see, new people will think about the yen trend or the dollar trend before really taking those trades, and older people will hedge. So that is sort of how this will get sorted out, and that is why I don't think it is a big issue. The other issue which happened sort of around the same time, which is why everything got aggravated, was around interest rates, right? The US came up with some data points. Earlier, we were thinking, yeah, we are moving in the right direction, but suddenly an unemployment report showed up which said that, oh, jobs are being lost. And then there were other reports which I read which are saying, yeah, these jobs which are lost have to do with immigrants who are not counted, and therefore it may be a false data. If you remove the immigrants, it may not be so bad, blah, blah, blah. So at the end of the day, that's not the only data point you watch when you're trying to call for an economic cycle, and there are many other data points say that we are at the bottom of the cycle, and in some cases things are actually improving or getting better. So it's not like across the board everything is bad. Yes, there are some indicators that show recession risk, but not every one of them. And because this has been much more of a controlled environment in which a lot of these things are happening, can we read this data the same way we read the last two times? Now, I've spoken a lot on this extensively, so I will not go into it all over again here, which is all about how interest rates and equities behave in an inflationary and a deflationary environment. My conclusion is this is an inflationary environment. It doesn't behave like the way it did in the last three recessions. Anybody making a prediction based on the yield curve and this unemployment report that a recession is coming can easily go wrong. So then what we look for is sentiment, right? We all come back to sentiment. I'm going to be doing a very detailed session on what sentiment indicators are, how they are calculated and all of that with Money Control's Learn thing. They have an event webinar coming up 1st September. I'll be speaking. It of course runs for 3-4 days. So it starts 26th or something. You can check that out. But essentially sentiment is the go-to tool, right? Even when we do Elliott wave analysis, Elliott waves is nothing but herding, crowd psychology. At the end, it is sentiment along with the wave count that has to match. And sentiment indicators are what we have on strike. So you can actually look at, is everybody bullish? Is everybody bearish? Where are we getting to? And so when we look at US sentiment, because that is what we are talking about first, US sentiment is essentially getting to the bottom end of the range on many tools. I've published again a couple of charts on those. And so we are getting oversold conditions. Some of them you're not, and some of them in fact just reached midway, like so let's take a diffusion indicator, if you know what that is. Number of stocks above the 50-day average for the S&P. It came down to the midpoint, a little below that, went up again, then came down. Then just before all these reports came out and the market sold off, it was actually going up. The reason it was going up after a long time when people were saying no stocks are participating is the expectations of falling rates finally drove banking and small caps higher, the Russell 2000, right? It all rallied very sharply. Some people said this is the sharpest rally in years and therefore it's outsized gains. It may be a false rally, a head fake. And then you got the unemployment report, everything sold off again. But that was creating wider participation on the back of the idea that rates are going to come down. The Fed is saying that. Now a week later, you have even better data, right? Now that was one data point that was trying to spoil the party. The data point has come and gone. Now you have inflation data, which is anyway subsiding. You had other economic data, GDP growth come in at 2.8% and so on. So one side you have things which are not slowing. You also have inflation which is falling. So it looks like a very nicely controlled environment in which we are saying, okay, growth is slowing down, but it's not slowing down across the board. And so it's like just normalization of growth. But inflation, that normalization is causing the inflation data to cool off, but it is not crashing. Like inflation data could have gone from 4 to 3 to 2 to 1 and we would be in rate cuts right now. Instead, it's going from 4, 4.5, 4.2. Now it's like 3.7, 3.6, 3.5. Like you're counting points month by month. So it's very slowly coming off, and the Fed is also being patient, saying it's coming off slowly. Let me not be in a hurry. So somebody asked me this question. Once the Fed starts cutting rates, inflation goes up, then they raise rates. Are we going to keep going back and forth? The reason the Fed is keeping rates this high is they don't want to go back and forth. They don't want to play that game. They want it to cool off and become settled so that they can actually have a low interest rate environment for quite some time before we deal with this problem again. Yeah, that means this problem is going to come back, but not here, not today, not next year, maybe 3 years from now. And that is the window in which we all try to make money, right? Where interest rates can go down, stay down, inflation is not a problem, growth is still there, government is still spending money, but not as much as it was doing in COVID. So the inflation problem will not be that big and that wildfire. But because we are in a weak dollar environment where you're monetizing debt, the dollar is falling, commodity prices do rise, you will get another inflation shock. But will that one be more driven by the same factors this time as last time? That is a very different question, and I think probably not. The factors may change. They may not be the same. So that's something we will think about, worry about, analyze, overanalyze 2 to 3 years from now. The window is now that they have managed through this so well. When they're going to start cutting rates, equities are also going to go up and not down. So people who have not studied the inflation, deflationary environments of inflation, equity, correlationship, the quantitative cycle, will not understand this. So you have a direct correlation between equity and stocks, basically, and bonds. Basically, what that means is if bonds go up, which is rates are falling, stocks are also going to go up. Now, the good news is that when the dollar is also falling along with this, see, because if all this selling was a risk-off trade of a major nature, you would have seen the dollar index go up. That is typically what happens, and then everything else is falling. That's not what happened. The dollar was falling. So we had a different environment, which is why it's more of a near-term correction. And then now this means that once we've settled into this near-term correction, the weak dollar is essentially good for emerging markets. We still haven't seen huge flows into India, but most emerging markets are doing better. A lot of Asian markets rebounded recently. Brazil has gone back to a new high, not a all-time high, but it's retraced like more than 50-60% of its losses that it had made in the last 6-8 months. So that is pretty good, So Brazil is back. Many other markets are starting to run up again. India is getting bogged down because while there was some signs it could pick up, we had the Adani issue. Now, one more thing to deal with. There are always domestic issues, right? And it was a nothing burger. I've already spoken about it in the media. They came up with something. First, they sounded it out. We have something on India. And then when they announced it, it was essentially an allegation on a person and what they have done in the past. Nothing that was significant because it was not present on the day that decisions are being made to investigate the Hindenburg case and the Adani group for anything. Did they really have any vested interest, at that point of time? Because what you had yesterday is like yesterday. Or if I owned Reliance Industries 10 years ago, and then I go on television and say, oh, I like Reliance, and then is that I have a vested interest in Reliance because I bought it and sold it 10 years ago? I mean, if that is not true, then how is it true that if you have no position in something, you have a vested interest? So, very hard to prove and get into, and it was just an attempt to throw something because clearly this case on most counts is being shut out. And one count left, and on that count, if we eventually say that, yeah, there was nothing in it and it's all cleared by the courts, then it puts Hindenburg in a bad spot, right? What about, you get trust issues and credibility issues and so on. So this was their last attempt to really get that credibility back if they could get something to stick, but it looks like that's not the case. So then why is the market under pressure for the last 3 to 4 days? Maybe it's weekly expiry because most after the Hindenburg report, these option guys ended up selling a lot of options, and to put it on conspiracy theory that they sold so much and if they're big sellers of options, they had no interest to really buy the market and cover it up. So on the day of expiry and before that, you had more than 5 lakh crores of more calls than puts. So imagine that many calls got sold and bought. And if everybody is holding on to longs, nothing's going to happen. That expiry happened yesterday. It's over. And now I'm sure that position would have changed by the end of the day. We'll see the data tomorrow. And once that position has really changed, now the markets can actually do something different, right? So that pressure point got created. So definitely there was an impact. The impact was that it created fear. Somebody sold a lot of calls and that fear kept the market down for the last 4 days. But finally, if nothing is wrong, if the whole world is recovering from the yen carry trade, and not only that, you are also starting to bet on falling rates and a weak dollar, then the Indian stock market has no reason to be down. The only thing which is still missing, which I think still bothers me, and I'm sure bothers everybody else, is these FIIs, why they just keep selling, and this is going on for years now and it makes absolutely no sense. Imagine the market's gone up multifold over the last so many years and they're still selling in terms of their net numbers. They're not net buyers on most days. And that is something which is very, very unusual because it's happening not only now, it's also happening when we were bogged down and on low valuations in 2021 and 2020. Now in 2024, despite growth and much higher levels, you're not seeing that. And when I look at research like from Hedgeye and so on, they've put India in quad 1, which means they think we are growing and inflation is low according to their data points, and therefore it's a recommended market on the top of their list for the last 9 months. And that's research based, right? And still we don't get flows. So it actually makes no sense what is really going on in the background. I have no idea. There was a time when FII flows were crazy. Even during the Y2K bear market, they were buying every month. Now we can say that they were underinvested on India at that point of time. Now maybe they are overinvested on India. That's been the theme, at least for banking. They've been saying most of the holdings are in banking. And so every time FIIs are selling, bank stocks underperform. And therefore today banking stocks have the lowest valuation in like 10 years. I'm talking about the private banks, which FIs buy. They don't buy the PSUs, or if they did, they sold it all. Maybe they're buying again. I don't know. I haven't tracked their positioning in PSU banks, but definitely in private banks, that's been the one reason that every equity sales research person has given that, oh, well, FIs are selling. But valuations are now at 10-year lows, right? So that is a brilliant spot to be in when it comes to private banks, and that's because earnings growth has been good. Like this quarter's earnings growth, June quarter, has actually seen pharma, banking and IT, I think, I'm not sure IT, but yeah, these, at least pharma and banking, showing very good numbers. Metals, sorry, not IT, metals showing good numbers. Okay, so metals have some issues. Their issues are not related to numbers. They have to do with the commodity cycle having cooled off recently, as the commodity prices sold off a lot. Copper, after its big spike, sold off, retraced almost 80% of the gains. Oil went back all the way to $70, almost breaking that level, and has bounced back now. So I think the commodity cycle is just waiting to start what we call as wave 3. It's waiting for certainty on rates, although the dollar is already anticipating that and falling, but commodity prices, except for gold, are not yet responding. Gold is holding up there pretty well. In fact, so is Bitcoin. Apart from a short-term correction, it's holding up pretty well. But gold, I think, right now is holding up the best out of all. Even silver is given back gains along with the other base metals. But that would sort of, kickstart that entire cycle and belief. I think maybe there is still some lack of belief in this entire theory, because there are people out there who are worried that maybe there could be a dollar spike, or will rates really come down, and can this all play out, and therefore flows from foreign institutions into India is still not making it big, though the environment is perfect. We should be buying Indian bonds. Bond yields should come down. I think bond yields will force an RBI rate cut. If RBI doesn't cut rates, the bond market will force it. That is my view. And it is coming. A lot more rate cuts are coming in India than in the US. In fact, that's another belief of mine. So rates and interest rates in India will go down a lot, will become a major trigger point for Indian equities eventually. But at this point of time, it has to start with something. And is that undervaluation or overvaluation? I think it's rotation, right, into undervalued stocks. There are a lot of undervalued stocks and sectors, even though there are overvalued stocks and sectors. And do overvalued stocks and sectors matter? If they don't have growth, it matters. Like you see in chemicals, like no growth, high valuation, it's going to keep getting beaten down every time it tries to go up. So that is what has been happening. They keep making attempts. There are stories. I look at the numbers. It's useless. Now there's some theories floating around that, yeah, they may actually start doing well. I don't know. Since they haven't done well, I wouldn't look at the numbers and predict anything. But where there are numbers, banking and financials are showing growth, 20-30% earnings growth for many of these major banks and financials, and the stock price is underperforming. Now here's a oversold sector, right? This is how it works. There are such stocks even in the auto space. There are such stocks even in the pharma space. Many have already picked up. We are not at the 2 standard deviations overvaluation range. How do I know that? Strike. Web.strike.money. Start your free trial now. So you can see all historical valuation charts there. You want to look at price to book, you want to look at PE, EV by EBITDA, EV by sales, whatever. And you can check it out, because if a company is making a loss, PE doesn't make sense. You look at price to book. If you're looking at banking, price to book. If you're looking at metals, PE ratio. If you're looking at pharma, EV by EBITDA, whatever. Market cap by sales, not EV by EBITDA. And so you can choose a different metric for different sector. Look at the history and you know where you are. 1 standard deviation, 2 standard deviations, above, below, on a nice, beautiful chart, which now will go from 10 years to 20 years of data. So you can see 2 bull markets, peaks and troughs, and take your decision. So when I'm saying banking is the most undervalued in 10 years, that is what it is. Private banks, some of the NBFCs have reached the bottom end of the curve on valuations. And that was true with pharma some time back. It's true with banking. It's true with a couple of auto stocks. And so there's always a case somewhere. For everything that is overvalued, there's a case somewhere, if not in mid caps and large caps. And that is why it's not done. That is why the index P ratio is still at 21 times, 18 times forward, not at 30 times where we would say this is clearly overvalued. And then the overvalued segments, if they are still showing growth, let me give you an idea. Infosys was showing 100% earnings growth. P ratio went to 150, 200. Some of the tech stocks even showed 300 P ratios at that point of time. Sure, high Ps are bad after the bubble ends. But at the time you have growth, none of them collapsed. The ratios remained high, stocks kept going up. And that is the nature of a bull market. So you have to really be able to sense whether everything has gone out of control. Are we at the final peak of moment? Is everybody bullish? Again, I say no, because I go by data. If my 4 friends are bullish, that doesn't mean everybody is bullish. I'm sure the auto guys trading sometimes you feel maybe you spotted someone doing it, but is every auto guy doing it? Then if everybody is trading in options as the SEBI is worried, then why are so many puts being traded versus calls? The volume put call ratio, check it out on strike, at the top end of the range just doesn't seem to come down since March of 23, because we are worried about too many things. The whole world is worried. And if you are worried every day, worried about valuation, worried about liquidity, worried about US debt, worried about election, then you're buying more puts than calls. But this is not about buying. This is not open interest. This is the volume, the actual volume traded, which is not coming down. And till that happens, I cannot say that everybody is bullish. And so if you're not at that point, then there's always room for something new to happen. And so that is why we come to sentiment indicators. And what are they indicating in the short term? In the short term, we had some oversold conditions a week back. And so I thought after the yen carry trade, we were done. We had that panic bottom, which we should not break. Nifty hasn't broken it. Bank Nifty did in the last few days. And that little bit of selling we saw in the mid and small cap stocks finally got the put call ratio, the open interest put call ratio, down to the oversold zone. So that's more of a shorter term indicator. And so we got now a couple of things which have gotten to the oversold zone. And that is why I think in the short term, we are sort of done over here, and markets are ready to run up again. Of course, looking at the last few days, the way it's been dull, it won't sound like that is going to be the case. But I follow the charts and the indicators and what they are telling me. So sentiment indicators, even valuation charts, I believe are sentiment indicators for the investor, because then you're studying sentiment at a macro scale, at a high level. You're looking at multi-year charts and checking whether the stock you own has reached extreme buying, because that's when the P's and price to books and other things all shoot off above 2 standard deviations, and then you're only chasing momentum, and then you need to take a momentum exit. So that is the whole theory of the strike valuation setup which we have under charts. Check those out. See you all next time. Thank you for coming. And if you've never used the Indiacharts app, you want to read my content on a daily basis, try to do that. And of course, we don't have a trial run over there. So you just have to subscribe and read. We're sorry about that, because we found a lot of misuse of the platform. So Chavan really did away with trials at some point of time, but we do have it for strike. Maybe we'll introduce something for Indiacharts at some point of time for people to try out. But right now, the only way is to subscribe and read my content daily. You, of course, can hear me as and when I do these sessions. So that's all from me right now. I think the worst in the near term seems over. All we are waiting for is to see that upward momentum, that pick up, because all the macro factors are also in place. Everything is in place. The market is still not responding. Hopefully, it will happen sooner than later. Thank you. See you all next time. Bye.